I'm Andrew Moran, Liberty Nation's economics editor.
Very, very rocky.
Death by government.
Drain the swamp.
Hello and welcome to another installment of Liberty Nation's Swamponomics videocast. I'm Andrew Moran, Liberty Nation's economics editor. This week, U.S. Treasury yields are soaring and nobody knows why. When the Federal Reserve kicked off its easing cycle with a supersized 50 basis point interest rate cut and signaled that more cuts were ahead, the U.S. Treasury market understandably tanked heading into the closing bell. However, since the September policy meeting, the bond market has defied market expectations. Instead of venturing toward the central bank's end of 2025 median policy rate target of about 3%, yields have been traveling in the opposite direction. As of October 23rd, the benchmark 10-year Treasury yield has rallied about 60 basis points to around 4.23%, the highest level since July. A mix of short and long-term yields has also risen. The 2-year yield reached 4.07%, while the 30-year bond topped 4.5%. This phenomenon is not only occurring in the United States. The United Kingdom, France, Germany, and Italy, and even Japan in some cases, have also witnessed higher bond yields. Canada has been the one advanced economy that has continued to experience lower yields as the Bank of Canada has engaged in an aggressive falling rate climate. Market analysts have been scratching their heads. Economists of the International Monetary Fund have also been confused as they cannot adequately answer reporters' questions during a recent press conference unveiling the latest fiscal monitoring report. So let's explore a few potential reasons as to why the Treasury market has been rocketing. First, are investors resetting their monetary policy expectations? Perhaps. While the futures market is penciling in a more aggressive Eccles building, the domestic monetary authorities have signaled that they are ready to be conservative and cautious on the way down to lower interest rates. Additionally, the Fed has essentially confirmed that rates are coming down based on the September summary of economic projections. So, if the median policy rate is seen decreasing to around 3% by the end of 2026, why would the 2-year yield firm above 4%? Second, is the inflation flame being rekindled? The September Consumer Price Index report was a mixed bag. On the one hand, headline inflation slowed, but on the other hand, it came in better than expected. Core inflation, which excludes the volatile energy and food categories, also unexpectedly rose. Plus, have you seen the Federal Reserve's latest money supply data? The money supply has increased for 8 consecutive months and is a few $100 billion away from returning to its pandemic-era peak. Perhaps this could be a signal that inflation could be roaring back, much like what occurred in the 1970s and 1980s. Is the rally in gold and silver telling us something? Maybe. Gold keeps notching record settlements, while silver recently touched $35 per ounce, its highest level since 2012. History might not repeat itself, but it certainly rhymes. Lastly, maybe investors are turning their attention once again to the debt and deficits. The U.S. government is on the cusp of reaching a $36 trillion milestone, while Washington is just coming off a $1.8 trillion budget deficit, the third highest on record. The Treasury is flooding capital markets with hundreds of billions of dollars in government debt in just a 6-month span. Treasury auctions over the last 18 months have largely revealed abysmal demand, though foreign purchases have accelerated in the past month. Billionaire investor Paul Tudor Jones recently made headlines when he said he was avoiding fixed income assets and shorting long-term duration bonds because of America's fiscal health. Here's what he said.
We're going to be broke really quickly unless we get serious about dealing with our spending issues, and unless we can either. I don't know if we'll be able to cut spending that much. 60% of our spending are transfer payments.
Meanwhile, the United States is on the verge of another debt ceiling standoff, with both sides inevitably going to reach a last-minute deal that fails to achieve much of anything. Others claim that Treasury yields are rising on a potential red wave, and bond yields could also be rising because of good news about the economy. At this point, we can only speculate as to why Treasury yields are soaring again, even in a falling rate environment. For now, this is great news for retail investors who want to generate some solid income without having to dip their toes in an overvalued stock market that is highly concentrated. At the same time, this might not be terrific news for taxpayers, as interest charges keep eating up a sizable portion of federal revenues and worsen the country's deteriorating fiscal health. It is a vicious cycle indeed. That's it for me this week. Please read my full Swamponomics column on the pages of LibertyNation.com, and be sure to check out my previous Swamponomics TV videos and interviews. Liberty Nation does not endorse candidates or campaigns or legislation, and this presentation is no endorsement. Thank you. I'm Andrew Moran, Liberty Nation's economics editor.
Very, very rocky.
Death by government.
Drain the swamp.